Hi, it's Andy Hoffman, Media Director of Miles Franklin Precious Metals. It's Wednesday, November 27th, mid-morning. I'm doing my weekly audio blog today because of the holiday, and I have no guest. First, I'm just going to go over some of the crazy things I see in the world, in the markets, and then I'm going to answer some questions that were sent in to me. And as always, you don't have to wait for audio blogs to send me questions. My job is to answer them either by phone, email, or any other method that you choose. Skype, you name it. Anyway, so I see gold this morning in the mid 1240s, hanging in quite admirably, given that Friday is the first delivery day for the December COMEX options contract. This is a big deal because December is typically the largest delivery month of the entire year. And as we've been noting here at the Miles Franklin blog all year, since April basically, when they started really attacking gold, the inventory, the registered inventory on the COMEX has been plunging. Registered inventory is the only type of inventory that's available to long contract holders, as the rest is simply being held for customers, kind of like us holding your gold at Brinks. So there is a chance at a gold default on the COMEX at some point. Now, of course, the powers that be will do everything in their power to obfuscate what's actually going on there, but it's pretty difficult to argue in the face of 3 million ounces of inventory in April going down to 500,000 or 590,000 as we speak. The only news today, of course, was durable goods orders fell quite dramatically. They showed that as usual, they show a falling weekly jobless claims number, but as I've mentioned for some time, those numbers no longer have any meaning because they have very little correlation to what's actually going on in the economy, particularly when you have a record low or a 35-year low in the labor participation rate, and the jobs that are being created, when you take out the phantom birth death jobs and seasonal adjustments, are typically low-paying, maybe minimum wage, part-time, temp help, waiter, bartender type jobs that hardly are the things of an economic recovery. Better yet, I just saw a great article on Zero Hedge. It's called A Glimpse Inside the Department of Labor's Curious Initial Claims Seasonal Adjustment. And this is what I've been talking about with these, referring to these claims and other economic data like NFP that are seasonally adjusted. It doesn't seem possible to me how seasonal adjustments could always be positive cumulatively throughout a year or even from week to week. And what they show is this particular last week, where they showed claims fell to 316,000 from 326. On average, over the last 3 years, this particular week had about 60,000 jobs lost based on the seasonal adjustment, but this week it had 37,000 added. So how can you have the same week a different direction seasonal adjustment? The point is, if you want to rig the numbers, then you can do whatever you want. And when you're rigging the market simultaneously, no one seems to care. They don't care about the fundamentals of Bitcoin, for example, when it's going up, and they certainly don't care about archaic economic data as long as the stock market's going up. But again, it's extremely important to realize this December COMEX option expiration is now. The pricing day was Monday, but the more important day is first delivery day, when people, the owners of the contracts, actually say to the exchange, yes, we have the contract and we want to take delivery. There was some confusion about what day that was because of this holiday week. It turns out it's actually Friday. However, for all intents and purposes, it's pretty much today, because tomorrow is a holiday, the market's closed, and Friday is a half day at best, and it's a day where there's going to be no traders in. There'll be essentially no one at work on Friday. And certainly if I was holding a long contract and had an interest in taking delivery, which is a significant investment decision, I wouldn't be waiting until the most illiquid time of the year, the post-holiday Thanksgiving market, to be making such decisions. So while the number of contracts open typically falls as people roll over their paper contracts into the next month right at the end, the fact is, going as of yesterday's close, as of Tuesday night's close, there were still 75,500 contracts open for the December contract, which equates to 755,000 ounces of gold, compared to the 589,000 ounces that are actually registered. So if we were doing this, taking delivery today, there would be a default. Now, of course, I doubt they'll all do that, but some of them will. And again, how low from 3 million, how low does that number have to go down before the cartel can no longer manipulate the price? Because people say, there's no gold there. Why are we pretending that there's gold there? I mean, people are paying 20% premiums in India for gold right now. And the other big news of this morning was China's October gold import numbers came in. Again, these are just the numbers coming into Hong Kong. Forget the numbers coming into the rest of China, which are not reported. 131 tons marks the sixth straight month over 100, and the second highest of all time, with only March's 136 tons exceeding it. So we are on pace for China to import double last year's record levels. But we're told that the price of gold is down 25% this year because demand is lower. So, let's just keep our eye on this. I'm not expecting anything per se on the COMEX because I've learned not to expect. But the mosaic of what's going on is pretty obvious. We have a record amount of paper claims on physical gold, and that physical gold is going away, and it will continue to go away. Now we go on. If we just want to look at the markets themselves and how crazy things have gotten, I see now that margin debt on the exchange has exceeded the all-time high of 2000 and 2007. Think about that. More margin debt on the New York Stock Exchange than at any time in history, including the top of the internet bubble. And this at a time where retail participation is as low as it's been in a decade. In fact, CNBC reported today, Zero Hedge reported, that CNBC's ratings are already back to 1993 levels. And CNBC is the perfect indicator of retail participation. There's no people in the market anymore. I mean, there may be a handful of people who have their IRAs have some stocks, but for the most part, this is the hedge funds, who, by the way, on average, are up just 6% this year after fees compared to 26% for the S&P 500. So it's just a bunch of computers that are just buying everything in sight. They don't even know what to buy. And the fact is, these computers are doing it on a record amount of hedge fund leverage and a record amount of margin debt, and still not producing results. That's the amazing thing. So that's what's going on with the record stock prices. And while we have record stock prices, we also simultaneously, just yesterday, we saw the lowest consumer confidence print in 8 months. In fact, some of the other consumer confidence numbers are the lowest we've seen in 2 years. And just this week, we saw that Obama had his all-time low approval rating. How can you have all-time high stock prices with an all-time low presidential approval rating? It just shows you that there is no people in the market. There is no more correlation between the stock market and the economy. It's all about the banks getting the free money, pumping stocks up, and the average person, as exemplified by the 50% of people on entitlements, and the 35-year low in the labor participation rate, are getting nothing out of it. So you talk about the dichotomy on so many levels, showing just how fragile the system has become. And what's going to break this bubble in psychology, or more importantly, what's going to break this bubble in debt creation? I don't know. I'm looking today. Everyone's getting all excited about how great things are in the United States because they printed another, fraudulent jobless claims number. But meanwhile, the dollar has been plunging against the euro. It's at the lowest it's probably been in a year against the euro. And even worse than that, look at the Japanese yen. I wrote a piece, I think around mid-year, right after they announced their qualitative easing, where they said they were going to double the money supply in 2 years' time. And I wrote a piece called "The Real Yen Bomb Starts Now," and that's the yen was got to 103 per dollar, and then it's since stabilized a bit, but now it's back to over 102. So we're just about at the all-time low, and now they're talking about increasing the QE in Japan, if you could believe that, after last month's disaster of a GDP report. Last week they announced it was up only 0.4%, and that with a negative GDP deflator. So people are now talking about they may do some, as I wrote last week, nominal GDP targeting, or actually targeting stocks themselves. So this is the backdrop in which we're watching gold prices be held down at their lows of the year. Not to mention, the mining industry just completely collapsing. And of course, there's Bitcoin, which just hit $1,000. I've been talking about it ad nauseum on in my writings and podcasts. The fact is, look, Bitcoin is an investment no matter how you slice it. It will never be money, even if it for some period of time is used as a medium of exchange. There are so many of these cryptocurrencies out there with unlimited supply, and there's an unlimited crazy industry that's growing up around it now, where private equity, just like last year, they all pooled their other people's money to buy houses. Now they're doing it to buy supercomputers, to mine bitcoins, litecoins. As it turns out, there's a dozen new of these new currencies coming out each day. And if you want to bet that Bitcoin will be the Google of the lot, and then nothing will happen to it as the Google lot, that's fine. But the fact is, the more that I look at it, the more I realize that it is an investment. There is not a chance it will ever be money. It doesn't have any of the properties of what money has been throughout history, i.e. gold and silver. So if you buy Bitcoin, buy it at your own risk. Maybe it'll go to $1 million a coin for whatever a dollar is worth, or maybe it'll go to zero. But I assure you gold and silver aren't going anywhere. And now that they're trading way below the cost of production on an all-in cost basis, both gold and silver, the odds of quote, losing a lot of money at this point are very low, in my opinion. But again, I don't buy them as an investment. I trade my fiat currency for them and hold them as my savings, knowing that over time, no matter what the powers that be do to try to change the laws of economic reality, they will always fail. Now I'm just going to answer some of the questions that were sent to me. Some of them may be a bit more generic than others. But I can get a lot of truths across just by these simple basic questions. Like here's a question: if you had money in a bank account equaling 100,000, how much would you invest in precious metals? And of course, I go back to my Protection Continuum article from a couple of years back. That really just depends on how comfortable you feel. I mean, do you feel like me that fiat currency is doomed, and that the powers that be will continue debauching your dollars and euros and whatever they are until they're gone? I do. And therefore, I won't say 100% of my liquid net worth in physicals, but it's probably 95. And if I weren't married, it would probably be a higher number. So that's the first answer. It's really up to you. What type of investment strategy would you employ? Buy on the dips, buy in a regular time interval. What time frame would you invest the money over? Again, I don't consider gold and silver to be investments. If you buy paper PM investments like mining stocks or ETFs or futures or GLD, you name it, that's another story. That's an investment. But I don't do those things and never will again, because as far as I'm concerned, it's a sure way to lose money in a rigged market. The difference between physical purchases and investment purchases that because of the rigging, people tend to buy the paper PM investments when they're rising near their highs, and the physicals they tend to buy at the dips. And so, generally speaking, I buy whenever I have cash, whether they're higher or lower, and I don't think in terms of a quote investment strategy. Here's a question: what's the ideal mix of gold, silver? Depends on what you feel comfortable with. Personally, I'm 50-50. That's what I feel comfortable with. Some people think that they should be 100% silver, some 100% gold, and some somewhere in between. And for different reasons, I might add. Some people like silver simply because it's more undervalued. It's indisputable that its value compared to the amount that's available is dramatically higher than gold. But some people feel that it's more volatile, and they are more scared of it. So again, I'm 50-50. In truth, I was 65-35 gold when this year started, but seeing what they've done to the gold-silver ratio, I've actually increased my silver, but I highly doubt I'm ever going to go over 50-50. That's how I feel comfortable. What's the best type of PMs to buy? Minted coins, rounds, bars, junk silver, what proportion? Well, the proportion I just answered. As far as the type of coins to buy, look, the basis of any portfolio has to be, in my opinion, the most liquid assets, the ones that people understand the most. Ironically, it tends to be the minted coins because it's funny that people would trust the government mints uh, more than anything when the government, every other agency is lying to them. But look, everyone needs to have, if you're talking about, let's say, gold, you need to have some gold eagles or maple leafs. Keeping in mind, of course, if you plan to store them, let's say at our Brinks facility, you're going to want to have 99 fine coins like maple leaves. But generally speaking, any of the main coins are going to be fine with gold. With silver, again, there's a lot more product out there. So yes, you definitely need to start out with a core holding of let's say eagles and maples, and of course everyone, as I wrote in an article, quote, must own junk silver for the worst case scenario. But assuming you have that core, you can really mix and match some of the other things to diversify. Generally speaking, at Miles Franklin, we don't recommend large denomination purchases, meaning large denomination bars, I should say, because they're less liquid, they're harder to transport. And even though we have never seen any counterfeiting, any examples that there have been of counterfeiting, if they're even true, in most cases, are large bars. So I would just stick with, personally, all I have is 1 ounce bars, 1 ounce coins, I should say, and junk silver. But it's up to you, whatever you feel most comfortable with. And keeping in mind that whatever you do have, Miles Franklin can help you to switch it out. I mean, we have people that call and say, I have 100-ounce bars. I'd like to convert them into 1 ounces. Can you help us? And of course, we can facilitate such exchanges. What proportion of your silver should be in junk, and what type, half dollars, quarters, dimes, etc. It really depends on what makes you feel comfortable. Off the top of my head, I would say it's no more than, I don't know, 2-3% of my silver holdings are junk, but some people want more and some want less. Remember, they're heavy to lug around. I mean, you can buy tiny little tubes with small amounts, but if you have a half bag, let's say, which has what is it, 360 ounces or so, it weighs 25 pounds. It's big and bulky, as opposed to the tubes that the coins come in. So it really depends on what you want. And as far as what type, half dollars, quarters, dimes, look, the dimes are the, quote, best barterable product because they're the lowest denomination. I think a pre-64 dime now is worth about 250, whereas you get a quarter, it's 2.5 times that much, and a half dollar, it's five times as much. So really, it's just you mix and match. But either way, as long as you have some junk silver, you're going to be fine. Here's if you had 20,000 in a rollover IRA cash account, would you set up a self-directed gold IRA or withdraw the cash, pay the tax penalties, and invest in PMs outside the system? Well, I think the longtime readers know what I've done. In fact, Andy Schechtman, our president, who's my age, did the exact same thing as me in the exact same year. It was 4 years ago when we were 39 years old, where we cashed out our IRAs entirely, paid the taxes, and paid the 10% fee happily. Keep in mind that those taxes are just going to keep going up in time. So the longer you wait, the less your IRA is going to be worth. For instance, this year the payroll taxes went up, and for the wealthiest people, they went up dramatic. The income tax went up dramatically, and the wealthiest people tend to be the ones who have the largest IRAs. So if you were someone earning, I think was the number $400,000 this year, your tax rate, just got bumped up. I think I forgot how much it was. Was it 6%? Some huge amount. And now that we have Obamacare and all these other socialist platforms, I mean, as my catchphrase that I've been saying forever is, if we're going to be the social states of America, we're going to have a socialist tax rate of 50+% on the federal level, not including state, local, and all kinds of other things. Heck, the banks are now talking about taxing us for keeping deposits. It's kind of a negative interest rate policy, and that's it. They say if the Fed dares try to do that to us, we're going to do it to you. So taxes are going up across the board. That alone is reason for me to get the heck out of the IRAs and retirement plans, particularly if you are over 59.5 and don't have to pay the penalty. But as far as I'm concerned, the bigger reason, which I've been writing about forever, as have David and Bill and pretty much everyone in our space, is that there are going to be confiscations of retirement plans at some point in the future. the worse things get, the more governments take. You're seeing it happen around the world. Heck, Poland just took half of all the pension plans just a few months ago. And if people just keep forgetting what happened in 2008 when the markets were crashing, the government, I think it was the House, was actively debating several bills regarding the confiscation of IRAs. They were going to put them into something called guaranteed annuities, GICs, what was it called? Guaranteed investment contracts, where they would tell you when you get your money back, and it would be something tied to Treasury rates, which of course they're hyperinflating. So the point is, there are so many reasons to get out of IRAs and other government-sponsored retirement plans. I can't even list them on a single audio blog. But for various reasons, some people choose to continue the IRAs. And for those, look, we have plenty of options here at Miles Franklin. Give us a call. We'll guide you to options where you can hold, have accounts that hold gold and silver in accounts vaults for you, or ones where you can actually hold them yourself within the IRA. Although, again, personally, I am a very strong believer in not doing this. But again, we have all kinds of options depending on what you're interested in. Here's a question that I get quite often. If you have, in this particular case, a person has 40% of his wealth in silver and gold coins. He also has the rest of his money is in cash, which he wants to get out of the system. And he's saying, would it make more sense to pay off my mortgage or buy more coins? And again, this is one of those things. It comes down to what you are most comfortable doing. Because, I get asked all the time. In fact, the next question relates to this very thing. What will happen to debt when the financial reset occurs? And I wrote a piece called Debt and Hyperinflation a few years back. But, since then I've learned a lot of things. I've learned, for instance, that in Weimar, Germany, they as an emergency measure, they indexed all mortgage payments to hyperinflation. So for anyone who thinks, well, my mortgage debt will be worth nothing because it'll be hyperinflated, that wasn't the case. They didn't allow people to pay off their mortgages with hyperinflated currency. So if that's part of your question, I would say don't ever think of your debt as an asset. That is the ultimate paradox. If you have debt, it may help you in some ways. Prior to this crazy debt orgy we've had since we've gone off the gold standard, corporations used to use debt prudently to increase assets, to increase returns. But now everyone uses it the leverage is just off the charts and so dangerous. And generally speaking, as a rule, I would say to never consider your debt to be an asset. If you happen to feel comfortable with the debt, or you feel you feel like you want to take an investment, you want to invest, and you believe that the price of gold and silver will take off quicker at a rapid pace enough and soon enough that it will offset the negatives of holding debt in a potentially terrible recession, then do it. I mean, it's up to you. Look, gold and silver are historically cheap right now. There's no denying that. And the odds are that, especially with what I'm talking about with physical supply, the odds are it won't last forever this way, and perhaps it won't even last another year before they start to get revalued properly, in which case you'll look like a genius if you put 60% of your money into coins instead of paying off your mortgage. But, me personally, I just from what I did in 2007, 2008, as soon as the market started falling, and back then I had mining stocks, as soon as they started falling, my survival instinct was to sell them all and pay off my mortgage. Because whether that's good or not, I mean, who knows? In time, maybe like in the Silver Circle movie, there'll be a Department of Housing Stability, or as they called it, House Tab, where they would take all the houses from people. Maybe they'll do that, and if you own your house, you get screwed. But personally, I gotta believe that if you own something, it's a lot less dangerous than not owning it, because if the bank owns it and the governments take over the bank assets, they may say, hey, anything with a mortgage on it is ours. So it really depends on what you feel most comfortable doing, because what we are headed into is unprecedented on all aspects, from financial to economic to political, and hopefully not to social aspects. So again, hopefully this is helpful for you. I'm very curious to see what will happen when we wake up Monday morning and see what kind of deliveries have been requested from the COMEX. I mean, what if 300,000 or 400,000 ounces out of that 755 are taken, and we're down to 100 or 200,000 ounces of registered inventory worth just a couple of hundred million. I mean, can the cartel really price gold in a worldwide basis with China having record buying based on a futures exchange that has no gold inside of it? From a, that's essentially run by a government that has no gold. Ask the Germans. And if you don't believe the government runs or owns somehow the CME, think about the fact that the CME didn't report COT data during the government shutdown, even though they're a stock in a supposedly public company. So anyway, it's a lot to digest. I hope everyone has an amazing Thanksgiving. I expect a lot of crazy things to go on in the world in the coming year, perhaps even the coming month. But hopefully, the good, smart people, I shouldn't say hopefully, the good, smart people like Miles Franklin will be here to help you answer your questions. And I wish everyone a happy and healthy holiday. Thank you.